All right, guys, so we are back with another round of portfolio reviews, and today we are going to go under the hood and take a look at 3 different portfolios. We'll check out all the holdings, and I'll give you my honest thoughts on what I like about them, as well as what I think could be improved. And as we're going through these, guys, keep in mind I am by no means a professional. These are just my amateur opinions, so definitely take them with a grain of salt. And remember that at the end of the day, this is all just for fun. Now, real quick, before we get into it, if you want to have your portfolio reviewed by me in one of these videos, just fill out the form I have linked in the description. And also, as we're going through these, leave me a comment below and let me know your thoughts on these portfolios. I'd be curious to get your guys' feedback as well. Now, guys, getting into our first portfolio of the day, this one belongs to my friend Luis, who's been investing for somewhere between 1 and 5 years. So Luis has been doing it for a little bit, and he's got a relatively short time horizon. He plans to hopefully live off his dividends sometime in the next 5 to 10 years, and Luis is really going hard with his contributions. Every single month, he's investing $5,000. In his notes, Luis says his portfolio is a work in progress for sure, and it's definitely changed a lot since the beginning as he learns and fixes his strategy to be thinking more long-term. Luis says, I still have some changes to make, but would love your input. Since I used to have a time horizon of 2027 to retire, that's why I have a higher yield, as we'll see in just a moment, but now I have extended it to 2031. So I will probably focus more on dividend growth stocks from now on and building those positions ASAP. Luis says, the monthly investment average is my historical average of new capital coming in, although this year, due to personal reasons, it has gone down a bit, but working on resuming in Q4 of this year. And now taking a look at Luis's portfolio over here on GetQuinn, which is hands down one of my favorite portfolio tracking tools. I highly recommend you guys check out GetQuinn. It's free to use, and there's a link to it in the description of the video. But anyway, taking a closer look at this, we can see Luis's portfolio is currently valued at just over $196,000. So Luis has really built this up in a short period of time, which makes sense. I mean, as we saw, he's investing $5,000 into this portfolio every single month. Now, one of the first things I want to look at in this portfolio is the breakdown. If we go over here to this allocation section or the diversification section, we can see that about 67.4% of Luis's portfolio is in ETFs, with the other 32.5 or 32.6% in individual stocks. And I really like this breakdown right here. I really like that the majority is in ETFs, but he's also got some exposure to stocks as well, which keeps it interesting. So overall, I think this is a really strong balance. But anyway, scrolling down, taking a look at all of the individual positions here, we can see first and foremost that the largest position by far is SCHD, making up almost 40% of the portfolio. And it looks like Luis has an even 1,000 shares of SCHD, which is very impressive. So I do like to see that. And it actually looks like the first 4 positions here, or rather the 4 largest positions, are all ETFs. We have VTI, so he's getting some good total market exposure with this fund as well. About 8% of the portfolios in that. And he's also getting some high yield monthly income from the 2 covered call ETFs here, JEPQ and JEPI. And while I'm not personally very partial to covered call ETFs, I will say I do think JEPQ and JEPI are 2 of the strongest ones if you're going to own any of the covered call ETFs. I do think these are some of the better options. And over the last few years since they've been around, they've actually done pretty well against the S&P 500, with JEPQ actually outperforming on a total return basis. But anyway, continuing on, looking at the rest of the individual positions, we're going to see some very recognizable names here as we scroll down. Realty Income, about 5.7% of the portfolio. Altria Group, about 5.5%. NextEra Energy Partners, NEP, about 4.3%. And this is the biggest loser in the portfolio. It's down 30.4%. And then if we continue to scroll down a bit more, we've got another ETF here, VYMI. So in addition to the total market exposure here in the US with VTI and some nice dividend growth stocks with SCHD, Luis also has some very nice international exposure here with VYMI. And then continuing down, we'll see a lot more names that we probably recognize here, like AbbVie, T. Rowe Price, Microsoft, EOG, Lowe's, FedEx, Ares Capital. So overall, I'd say for the most part, these are all very strong positions. But with that, the only company that I am a bit concerned about is NEP right here. Right now, NEP has a 114% payout ratio, which obviously is unsustainably high, and this looks like a pretty normal occurrence for this company, which could mean that a dividend cut is on the way. We'll see what happens, but it looks like analysts are starting to think that could happen as well. So that is one thing to keep an eye on. But anyway, my only other note for this portfolio is in regards to these 3 bottom positions here: FedEx, Hercules Capital, and Ares Capital. And while I think these are all fine companies, companies. I actually think these bottom two here are pretty strong business development companies, BDCs. I'd be curious to know what your plans are with these three companies, because as we can see, these are all very small positions, all less than 1% of the total portfolio. And I'm wondering if you'd be better off not having those in your portfolio since they are such small positions. So freeing up that money and reinvesting elsewhere just to have less overall holdings to manage. And if we look at this column right here, we can see that none of the other individual positions are large enough that doing so would make them too heavily weighted in your portfolio. Like none of these would be too out of whack if you were to sell out of these three small positions and reinvest into some of the other positions. But overall though, I think this is a very, very solid looking portfolio, and you've really done a great job building this thing up in a relatively short amount of time. And it's going to be interesting to see what this continues to grow into. I mean, if you do end up investing $5,000 per month on average between now and your timeline of 2031, this portfolio is just going to be a behemoth. You'll be over $600,000, $700,000 in this portfolio easily. So you'll be sitting pretty with that dividend income at that point. All right, guys, now getting into portfolio number 2, this one belongs to my friend Jacob, who is relatively new to the game. Jacob's been investing for less than 1 year, and he has a relatively long time horizon. Jacob has a lot of good years of compounding ahead of him. He plans to hopefully live off dividends sometime in the next 11 to 20 years, and every single month, Jacob is investing $500. Now, in his notes, Jacob says, "I'm 18 years old," which is awesome to see. Getting started with investing very young. Jacob says, "I work at a coffee shop and I get paid roughly $700 bi-weekly." Although I do think he means bi-monthly. But anyway, $500 of that goes straight to stocks. But anyway, guys, Jacob has shared his portfolio with us over here on Blossom, which is another great platform. You can use it to track your portfolio, but moreover, I look at Blossom more as a social media platform. In fact, this is a social media platform specifically for investors, as you can see from all these posts here. They're all investing related, but it's also a portfolio tracker. Like if you guys wanted to see my full portfolio, you can do so over here on Blossom, and it's pretty easy to find. Up in the top left there, if you download Blossom and sign up, you can just search Ryne, and that's my username here on the platform. But like I said, you can see my full portfolio. I'm posting some stuff over here that you won't see anywhere else. So overall, it's a really cool platform. I highly recommend you guys get on Blossom. It's a really great community of investors, and it's another great way to track your portfolio. So if you want to check out Blossom, there's a link to it in the description of the video. But anyway, guys, over here on Jacob's platform here on Blossom, we can see his username is Bullish Buzz. So if you guys wanted to check out Jacob and shoot him a follow over here on Blossom, that's where you'd find him. But in his bio here, he says he's 18 years old. We already established that. And he's starting with about $3,500 in his Robinhood account. So right now he's got a $3,500 portfolio at 18 years old, which is fantastic. And if we scroll down, we can view all of his holdings right here. And we're going to see some very recognizable names. I mean, the first 5 are going to be very recognizable. Amazon, Nvidia, we've got the S&P 500, Google, and Meta, and then it looks like there's some other ETFs in individual companies here as well. Now, before we get into some of these holdings here, first and foremost, I do want to say, Jacob, man, I am extremely proud of you for getting started with investing so young. $3,500 at only 18 years old is very impressive, and you are never going to regret starting this young. It's going to be one of the best things that you can do, and seeing people starting with investing at this age is one of my favorite things. I love to hear that there's younger investors getting started, and I love to hear that people are getting started so early, because one of the things that you'll hear every investor say, I'm sure at some point Jacob will say it as well, is that they wish they would have started early. So the fact that you are starting at your age is beautiful. So good job. Now, getting into the portfolio and getting into these holdings here, one of the first things I notice is that the top 3 positions here, Nvidia, well, the top 3 individual companies, Nvidia, Alphabet, and Meta, these are all some of the top 10 holdings in VU. These are all some of the top 10 holdings in the S&P 500, which is your number 2 position. Now, because of that, I do think an argument could be made for selling out of those 3 positions and just reinvesting that money into VU, since you already have that exposure and you're already buying that by owning the S&P 500. On the other hand, though, with that said, there's also nothing wrong with owning the individual companies outside of the fund if you specifically want more exposure to those companies. And if that's the case, then just keep on keeping on, I suppose. But anyway, that aside, some of these other companies here like Hims, I'm familiar with. Robinhood, I'm certainly familiar with. Palantir, I'm mildly familiar with, although I've never looked into the financials of any of these companies. So I don't really have a solid opinion on these companies in your portfolio. But if we look at the all-time return, it does look like you've done pretty well with all of these positions. I mean, you're up up almost 19% with Hims, so that's great. Palantir, you're up almost 8%. The only one you're actually down on is Robinhood, but that's only about 2%, which is not a big deal. And with that said, too, you don't have any crazy exposure to any of these companies. I mean, Robinhood, the only one that you're down on, is only 3.2% of the portfolio. So I really don't have any qualms with you holding any of those. And at the same time, too, you're only 18 years old. So, you've got plenty of time to see how these play out and take on a little bit more risk and see how it works out for you. So once again, I don't really have any qualms with you holding any of those positions. I will say, though, the one holding that I'm not crazy about seeing in this portfolio is NVDY. In general, I just really don't like any of these yield max funds. I don't like NVDY, I don't like TSLY, and I know the yields are high with these, but I don't think that will be sustainable over a long period of time. And I think for someone at your age, at 18 years old, I think you'll be much better off investing with something that has a lower yield, but offers more dividend growth. I mean, your timeline is a decade to 2 decades. That's a long time, and you'll be able to take advantage of some really great compounding and really establish a solid yield on cost by going with something lower yielding that offers more dividend growth. And although I do like JEPQ, we kind of talked about that with the last portfolio, I share the same sentiment with this fund as well. I think ultimately you're going to be better off going with securities that are lower yielding that offer more dividend growth. Overall though, man, keep up the great work. Okay, you're off to a fantastic start so far. All of these holdings have done really well for you. So overall, I'd say you're on the right track and your future self is thanking you for getting started so young. It's going to make a really big difference in your life doing this at the age you're doing it. So great job. And with that, guys, moving on to our third portfolio of the day. This one belongs to my friend Retro, which I think is a really cool name. Retro's pretty cool, but Retro's also relatively new to the game. He's been investing for less than 1 year, and just like Jacob, has a timeline of 11 to 20 years. Now, as far as the contributions to the portfolio, Retro is investing $100 to $200 every single month, but Retro said they're starting a new job, so looking to increase that amount by 10 times, which would be awesome. $1,000 to $2,000 per month is impressive. Now, as far as the notes go, Retro says SGMO was one of my first stocks I bought. Says during that time, I wasn't doing my due diligence when it came to investing in research. It's my biggest loser by far. It got pulled off my broker too, so I can't average down. If you do look at my portfolio, I look at SGMO as an anomaly. He said I'll sell it for break even or for a small loss when the time comes. Since then, my focus has been dividend growth stocks. And now if we jump over and take a look at Retro's portfolio over here on my dividend portfolio tracking spreadsheet, which just like the other 2 platforms we've seen today, you can start using for free. There is a link to download the spreadsheet in the description of the video. But looking at some of the stats here, Retro's portfolio is currently valued at about $781. So less than $1,000 here. Retro has a 4.1% yield and a near 6% dividend growth rate. So overall, I think these stats are really solid actually. And if we look at the composition of this portfolio, one of the first things we'll notice is that there are quite a lot of positions in this bad boy here. I think in total there are 24 different holdings, with SCHD here being the largest at 22.5% of the total portfolio. So I do like to see that, and actually it looks like about 40% of the overall portfolio is in ETFs, which is something that I do like to see. But still, truth be told, as someone who's just starting out with investing, less than $1,000 in this portfolio, even though 40% is really nice in ETFs, I would like to see a larger weighting of ETFs overall. So I'd really like to see this instead of 40%, which is great. I'd like to see that more 50% or 60%, possibly even up to 70% of the overall portfolio. And looking a bit deeper into all of the individual holdings here, we're going to see a lot of familiar names. And here's that SGMO that Retro was talking about in the notes. But we'll see a lot of familiar companies like Altria Group, Vici Properties, Realty Income, Starbucks, DGRO is in here, which is good to see. We've got Coca-Cola, Home Depot, VOOG, which is the Vanguard S&P 500 Growth Index. So just with the ETFs, I think this is pretty well balanced. You've got some growth exposure there, S&P 500 companies right there. You've got DGRO, so nice dividend growth, and then SCHD as well, also some nice dividend growth. And then the rest of these individual positions I think are all really solid. I actually don't have any issues with any of these right here. We've got Louis Vuitton, Lowe's, AbbVie, J&J, JP Morgan, Visa, Procter & Gamble, Microsoft, and you guys will know out all of these as well. With that said though, 24 different positions is quite a lot. And with $780 invested, I just don't think you need to have this many different positions in your portfolio, especially considering a lot of these make up less than 1% or actually less than 0.5% even of the portfolio. There's 11 different holdings right here, I think, that are less than 0.5%. But I get it. When you first get started with investing, you think you need to cast a wide net to build diversification. You want to have a well-diversified portfolio, which is true, but I think there's a better way to go about it than having all of these individual positions. It's quite a lot. So overall, I think there's a lot of room to consolidate in this portfolio and streamline this portfolio. And if I was you, I would probably just have 2 ETFs, like I do SCHD and VOOG, or maybe even DGRO and VOOG. I think either of those would give you that diversification in a more simple way. And then in addition to those, I would maybe choose 1 or 2, or definitely no more than 3 of some of these individual positions in the portfolio. I would choose the ones that you understand the most and have the highest conviction in, and I would keep those. So total, we're talking no more than 5 total positions, maximum 2 ETFs and 3 individual stocks. I think you could even get by with less than that. But I think approaching it from that way would give you the best of both worlds. You get that diversification from owning those 2 different ETFs, which in themselves are different. So it's even more diversification, and you'll also be able to start getting some reps in and start getting some practice analyzing individual companies with the 1 or 2 or 3 individual picks. So overall, best of both worlds. It's going to be a lot more streamlined than what you've got going on here. Even though these are all great positions, I don't think you need all of them. And then the last note here, you mentioned that you would sell this company here, SGMO, which looks like it was just some type of penny stock here. You mentioned that you would sell this when you break even or only when you see a small loss. Well, if we look at the returns, right now you're down about 67%. And just for reference, to break even with the loss that you're incurring now with SGMO, you would need to see probably like a 170-ish% return just to get back to break even, which is pretty hefty. And so if it was me, I personally wouldn't wait for that to happen. I mean, at the end of the day, this was only a $140 position to start with. Okay, what's left over is about $46, $47. So you're not even down $100. I would just take the L on this one. If your plan is to sell out of it, I would just do it now. At the end of the day, a near $100 loss, 90, 95 bucks, it's not going to be a life-crushing amount of money. So ultimately, I think you'll be best off just selling out of this and reinvesting elsewhere, and do that as part of your consolidation. Overall though, Retro, I think you're on the right path. I think you're off to a great start, and I think your plan of focusing more on dividend growth moving forward works perfectly with your timeline. So keep up the good work. Anyway, guys, with that, those were our 3 portfolio reviews of the day. And if you want to see some more portfolio reviews, then check out this next video right over here. In this one, we're diving into 3 more of your portfolios. And just like in this video, I'll give my honest thoughts on each one. And I'll tell you what I like about these portfolios, as well as what I think could be improved. So click right over here to check that out, and I'll see you in the next one.